Last week was an extremely important week. It was possibly an inflection point for markets. Do you want to know where they're going to be in the weeks ahead? Well, are they going to be up? Are they going to be down? Well, there were some very important things that happened in the past week. We've got to take a look at the details of that right now. The S&P 500, which I often call the big index, right? The 500 largest market cap companies in the world. That closed up 1.92% on the week. That was generally positive. And again, the theme sort of drove the market there. That's a really nice close for the week. But the big news is the Dow Jones Industrials. That is an index that dates back even before I was born. And just by looking at me, you know I was born a long time ago. So it's been around a long time, and people like to make fun of it because it's only 30 stocks. And the way in which the index is calculated is an interesting one. We will probably do a whole segment on that once. But the fact of the matter is the world still watches the Dow Jones Industrials. And the Dow Jones Industrials closed up 2.2% this week, part of the market, especially with the Dow. People love those round numbers. And we watch that, right? But there's a reason for that. We know, even technically speaking, that round numbers are typically act as resistance points and support points and points of inflection, meaning the market can, after closing above those, go much higher or they might go much lower, right? In this case is a big deal. I don't know if you remember, but back in the day when there actually used to be real traders on the floor of the New York Stock Exchange, there's still a few of them there. And we should definitely go there someday. And I will introduce you all to some of my favorite traders on the floor that are still there. There's some really colorful ones out there. But back in the day when the market was full of traders, you would see anytime we made any of these major closes above these magical numbers, you would see them all walking around with hats. In fact, some of these old timers, they have a collection of hats that have the numbers of them on it. And I remember 500, I remember 1,000, but it's not as broad of an index. And so when you see that index close higher, which is, and if you see the makeup of the Dow, it is pretty broad. So it covers banking, it covers industrials, materials, it covers all sectors, right? So it's not tech-led for a change. And so talking about tech-led, the NASDAQ is tech-led. It is a tech-heavy index. And that was up 2.31% for the week. That really is a testament to what I said earlier in terms of the continued upswing of technology. People have high hopes for tech. We're going to start to get those earnings in the weeks ahead, and we're going to watch that carefully. And that was a good sign, right? So growth is still very strong. And finally, another great story: the Russell 2000. The Russell index is the small cap index, and the small caps have had a rough time. You go back in history, long time in history, the small caps typically lead the markets. So we always look at small caps. Historically, they've been the best performers, interestingly. But if you've been following the markets in the last 5 years or so, or prior to that, you would think, wow, the small caps are the worst, right? But historically, small caps are very, very important. And if you look at some very important academic literature, Fama French, you see that is an important factor of the entire market, small caps. And so anyway, let's talk about small caps. They have been struggling. They have been lagging the markets. And however, they did have a pretty good upswing in 2000 and 2021. Everyone thought they were back. And then the Fed started raising rates. And the second the Fed started raising rates, small caps and the index got hammered. And that hammering kept them down for quite some time. And there's a reason for that. Small caps are more reliant on borrowing and therefore are more sensitive to interest rates. And so when the Fed's raising interest rates, that just means their costs are going up, their prospects are going down, all that kind of stuff. So you will see that the small cap index is very, very sensitive to interest rate policy and interest rate moves and projections of interest rate policy. That is why, if you look at the chart, put that chart up. If you look at the chart of the Russell 2000, you will see that it sort of traded sideways through the end of 2023, and then started to climb as prospect of rate cuts rate cuts increased. The Fed was going to pivot. Once the Fed pivoted, we saw the Russell 2000 take off, almost getting back to their 2021 levels before they got slammed. And then, of course, 2025 happened and all bets were off, right? Because all of a sudden we were worried about inflation. We were worried about possibility of the rate cutting regime stopping. And then you saw the Russell get swamped again. And so if you look at the chart just over the last year, it looks like a roller coaster ride. And so basically we saw the markets tank by March when all the markets were down. Russell was just beaten down. However, since those trade issues were resolved, you can see a really, really, really steady climb up. And again, Friday really sort of topped things off. This week we saw all-time highs achieved, and that has a lot to do with, again, these potential hopes of rate cuts. And I told you earlier, there are high probabilities at this point. We're expecting 2 rate cuts between now and the end of the year. For now, we'll see what comes next. Let's talk about bonds. Bonds are extremely important, and I always watch those. Those are boring because they don't have stories, but they're very telling of the economy, and they're very sensitive to economic releases. We haven't gotten any other than Friday's CPI number. But bonds had an interesting week. I like to look at the 10-year, the 2-year, and the 2-year. The 10-year because the 10-year really is under the control of the markets, the bond vigilantes. And those are also used, basically have a high influence on mortgage rates, which impacts most of us, right? And the housing market. And so the 10 years have been coming down, 10-year yields have been coming down. This week, they were below 4%, which was one of those magical numbers. There are no hats for that one, but 4% is a magical number. It's one of those round numbers that people like to watch. So it's an important technical number. We did see the 10 years trading below 4% for a couple days this week. They did close the week out at 4%. And so basically flat. It was 4% at the end of last week. It's 4%. So no great story on the surface, but if you followed it during the week, you would have seen a lot of upward and downward movement. A lot of that had to do with, again, any news items that came out were highly impacting that 10-year. Now, the 2-year is not controlled by the Fed, but the 2-year is highly influenced by Fed policy because the 2-year is trying to figure out where overnight rates are going to be in 2 years, which is, no time for old people like us. But 2 years from now, where the overnight rate is, and the overnight rate, of course, dictated by the Fed. So if there are expectations that the Fed is going to be cutting over the next 2 years, and those expectations go up, you see 2-year yields come down, and so on and so forth. 2-year yields are not as influential in the financial markets, but 2 years to 5 years could affect ARMs, adjustable rate mortgages. They can impact equity loans and things like that, home equity, HELOCs. And they also impact adjustable rate borrowing in the institutional real estate market. So 2 years are also extremely important. And that's how the Fed indirectly influences those markets. And so 2 years were closed up slightly by 2 basis points, but that's really just mostly volatility. They're at 3.47% right now as of Friday's close. That brings me to the yield curve, right? So we watch the yield curve. The yield curve simply just plots all the yields of the different maturities, starting from 1 month all the way out to, let's say, 30 years. But I like to look at the 2s, 10s, the 2-year to 10-year yield curve. And that the reason we watch that is because that shows you what the term premium is. That means what the market is estimating the risks of holding a longer term paper is. That's really important. And that's something we should probably cover here in a separate segment. But the most important thing you need to take away from the yield curve is that 2s, 10 yield curve, when it gets flatter, that means we're expecting trouble ahead. And if it goes negative, upside down, which it had in the past many times, it usually portends a recession. Right now, no worries about recession, at least according to the 2s, 10 yield curve. That remains positive. And that curve flattened by around 3 basis points. That could just be a little bit of volatility, and that's nothing to really worry about yet. But we're watching, and we want to let you know. Commodities. Let's talk about commodities. Crude oil, WTI. Crude oil is important. Crude oil is, I like to say, the oil of all industry. But more importantly, it impacts certainly you and me on what we're going to pay at the pump. Crude has been under pressure for some time now. You may recall. Now I look at WTI crude because WTI is West Texas crude, and I like to watch WTI because this is America, and that's what we watch here. And WTI crude was below $60 a share, which is a big deal. We thought that, that was pretty cheap, but we thought maybe it can go a little bit lower. Why? It's a recurring theme. There's a lot of supply out there. OPEC continues to pump a lot of supply. And the US, of course, it's drill, baby. And so there's a lot of supply out there. When supply goes up and demand stays the same or goes down, guess what? That means that prices are coming down. Okay. So that is why crude oil has been under a lot of pressure. That's important. Why is it important? Because let's go back to the CPI. Inflation. Headline CPI includes energy costs. And so if we have an environment where prices at the pump are going up, well, guess what? Inflation is going up. The Fed looks to look at, interestingly, core inflation, which doesn't include energy and food, which I think is rather silly because we all need energy. In other words, we have to put gas in our cars, and we all need food to survive. So if food prices and energy prices are going up, it's painful for everybody. That said, we don't want to see crude going up. We'd like to see it coming down because that sort of helps the inflation thesis that inflation is going to normalize back down to hopefully 2% sometime in the future. But this week, crude went up. Why did crude go up? It actually was up 7.6%, and it was above $60 a barrel. 61.50 to be exact is where it closed out the week. Why is that? Well, it has everything to do, as I alluded to earlier, with discussions that are going on right now with Putin. Russia is in the top 3 producers in the world of crude. I think US is number 1. Saudi is number 2. They're either 3 or 4. I'm not really sure where they are in the mix this month. You can go check that out, but they're up there. So if Russia is somehow not going to be producing or not allowed to introduce their oil into the global supply, well, guess what? Supply coming down. Supply coming down, prices going up. Basic economics 101. Okay. We talk about that all the time. So supply coming down because of Russia. It's not just about the talks that are breaking down between the president and Putin, but also about the fact that all these countries are now about to introduce sanctions on Russian energy in order to pressure Putin to come to the table. Additionally, you saw some great wheeling and dealing happening with India. India was buying a lot of Russian crude oil, partially or fully, then refining it and then turning around and selling it legally. And President Trump recently put a lot of pressure on India to get them to stop buying Russian crude oil, right? Because buying Russian crude oil is fueling the Russian war machine. So that was a big theme this week, and it shows up in the commodities. The reason I bring it up is, whether crude is trading at 58 or 61 probably means nothing to you, but it does impact inflation. And more importantly, you have to recognize that all these geopolitics have very real impacts on the numbers. It's all about the numbers. Let's talk about gold. Rocket Ride Gold actually fell this week, 3.3%, still above $4,000 an ounce. But it's been very hard for us to talk about gold falling because every week when I have write this report, gold is up, gold is up, gold is up, and it keeps going up. And we put out a lot of videos on that. You should check out some of them. And we talk about why gold is up and why it may be up more than it should be up, and why most Wall Street insiders are reluctantly accepting it. But Wall Street insiders, I can tell you, are concerned when gold is this high. But Gold has been high and getting higher, and people are starting to wonder, should I just get out of its way? Well, gold pulled back a little bit this week. It's nothing to write home about, but it is unique to see gold actually down for the week. It's still above 4,000, so I would not call it any major change. In fact, a lot of people are calling it just a technical pullback, right? The market has to take a breather every now and then. And so you have what we refer to as buyer exhaust. And that could have been happening this week as well, right? Because certainly if you're looking at gold as a fear index of fear, certainly that has not changed, right? There's a lot of fear that's still out there that if you believe that would be propping gold up here. The next thing I want to talk about, the dollar index. We look at the dollar index very, very closely. And the dollar index, as a reminder, is the US dollar versus a basket of currencies with our trading partners, right? So you can gauge whether the dollar is strengthening or weakening. We've been talking an awful lot about that in the last year. And that is because the dollar has been weakening quite a bit. And there are lots of implications on that. And so we don't want to really sort of get into that today, but I do want to remind you, because we were just talking about gold and crude. Those two commodities, international commodities, still traded in the US dollar. Whether China likes it, or Turkey likes it or not, it's still traded in US dollars. So when the dollar gets cheaper, when the dollar weakens, that makes these commodities cheaper to foreign buyers. And that also helps actually giving some push and puts wins in the sails of these commodities. Crude, which it's not been helping crude, obviously, but it may have been helping. It may have been helping certainly gold. So we watched the dollar index, and the dollar index this week was pretty flat to slightly higher. So no big news there, but I just want to keep it on your radar because we're watching it very, very closely. So anyway, the sentiment is really important. Clearly, the sentiment is very positive, the investor sentiment. If you follow fund flows, and we do, and we report on them, you see a lot of retail money flowing into the market, specifically equity funds this week, and has been the last several weeks. Interestingly, if you take a step back and look at institutional money, retail investors have been running into the market, and institutional investors have been running away from the market. And as it turns out, the retail investors, right again. And, retail portfolios are outperforming institutional portfolios. I'm talking about hedge funds because the hedge funds are trying to get a little cute, but retail investors, they see the long-term positive momentum. They feel it, and the stories are good. And the stories are backed up by solid earnings. Now, that doesn't mean everything's perfect. Okay, there's still lots of cracks. But that said, investor sentiment is pretty strong, both on institutional side and retail side. Now, some people, by the way, look at that as an inverse indicator, right? So if retail is jumping in, that means markets are going to go down, right? Because retail investors are supposedly stupid. I disagree. We can cover that in a whole separate segment as well. But traditionally speaking, there is this odd lot theory. It's called the odd lot theory, where institutional investors look for when the second retail sentiment gets high, it's time to sell. And there are all sorts of great adages I could tell you from my old Wall Street adage book. But that's not the case. Retail investors have been really, really smart about their investments in the last, let's call it, 5 to 7 years. And they've been right more than institutional investors. Interesting, right? And that was your markets rundown. But guys, the markets move every day, every single day. Some of them run 24 hours. Why wait to the weekend to hear about what's going on? So click like and click subscribe so you could follow it during the week. And then, of course, show up for the recap. And that was your weekly recap of the markets. Remember, at Truth Bombs, we drop them here before the market even figures them out. Thanks for checking in with Wall Street Truth Bombs. Remember, we drop them here before the market figures them out.